Yes, things are continuing to slow down. And in fact, going into the calendar year, our expectations were, in fact, for the macro environment to continue to be bumpy. And investors would probably get some downside surprise from that respect, but it was the upside potential in terms of the reforms agenda. So since the plenary session last November, we've seen over 100 fairly significant reforms being introduced. In terms of the overall environment, a lot of people used to refer to new China names having at the expense of old China names. And what we've done this year is really combine the two. So having a balanced approach between both areas. Now, in terms of the consumer, a lot of people are saying with the anti-corruption campaign, a lot of consumption names have been hurt. But the mass market is still very, very interesting. So people upgrading, so for example, whether it's buying an air conditioner for the very first time, whether it's buying furniture, whether it's buying a car, people are still traveling. In fact, perhaps one of the biggest exports to come out of China in the future will indeed be the Chinese tourist. Well, sales are still fairly weak, but we are seeing somewhat of a sequential improvement. But in fact, when you look at various data points, the recent one I read was 1.4 billion square meters of property is still available. Or put another way, that's 12 months of sales in terms of clearing out that inventory. But in China, what's really important is there's still this underlying demand, and we are seeing some tweaks in terms of policy. But the easing measures we have seen still haven't come through into the market. The biggest risk will be that the government loses their nerve. The biggest risk is that they will implement a huge stimulus plan like they did back in the global financial crisis. And they've been saying since they've been in power that they don't want to implement old policies or old-fashioned policies. So it's about remaining on track.